Good afternoon and welcome. My name is Steve Jewell with CommunityGiving, and we welcome you to our professional advisor webinar series that we've been doing actually ever since COVID started, and not doing quite as many webinars, but today we are just really delighted to have with us two really outstanding professionals from the areas that we serve, from the Willmar area and from the greater St. Cloud area. I'll get into introductions in just a second. We're going to give people time just to get into the room. We have a few people that are signing on, and we had a number of people register. And please note that today's event will be recorded. So if for some reason you have to step away, we certainly will be able to get a copy of the recording so you can hear it in its entirety. Also, we'll be sharing that out. As we go through today, we will also be having questions and answers towards the end of the presentation by our guests, but feel free as we go to just put them in the chat and the Q&A tab as well, and we will get to your questions. So with that, just want to welcome our two really outstanding individual professional advisors from our local community. Their bios were included in the mailing ahead of time, so I'm not going to read those word for word, but just want to welcome and introduce to you Kurt Gerwachter, who is the CEO and founder of Ledge Wealth Management, headquartered in Sartell, Minnesota, right here in the greater St. Cloud area. And Kurt has been in this profession and business for many years, and we're just delighted to have him with us today, as well as Joel Gratz. Joel is a CPA with Christensen and Associates in the Willmar area. Also of note, Joel served on the board of the Willmar Area Community Foundation and reminded us today that he was one of the board members that was there when we were fortunate enough to hire our executive director down there, Sarah Carlson, who's a wonderful team member of ours and does a great job in the Willmar market. The format for today is we're going to start off with Joel providing a little bit of background and overview of the tax situation, and then just give time for both Kurt and Joel together to talk about how they work with clients and some of the tips they give their clients, especially at year end, as they plan and look to the future. So with that, love to once again welcome all of you, and especially Kurt and Joel, and turn it over to Joel to get us started.
Awesome. Thank you, Steve. Appreciate the opportunity here for community giving. We do have a few slides just to start to go through some of the tax law changes that could be coming, and I say could be because no vote has happened. And what you're going to see, I have it dated 9/15. This stuff changes almost daily based upon the ebbs and flows of negotiation, how we all know politics can go. A lot of scary stuff out there that's been talked about, and I thought it'd be a lot easier to put it on the screen and kind of go through that. Kurt and I, when we were working together on the planning session, it's like, all this doesn't mean a lot unless we know what the tax law is going to be. And Kurt said, well, I have a crystal ball, Joel. I'm only going to let you use it for about 2 seconds. And I'm like, man, you have a crystal ball? Maybe I could talk to you more about that. But I wish we had a crystal ball to do our planning. That's the hard part. And obviously I'm joking because maybe I'm not Kurt. Do you have a crystal ball? Maybe you do have a crystal ball. He's shaking his head.
I'm still working on it. Yeah.
Awesome. So if we could go to the next slide, Amy, that would be awesome. And we're going to start here with the tax bracket and the tax percentage changes. A lot of numbers there, but I just kind of wanted to line up where we're at today for a married filing joint. You can see the various brackets. It ends at 37%, and you can see that it starts at $628,000. That's where we're sitting today for 2021. With under current tax law, and to the right you can see the proposed, and you can see there's a lot of different numbers there where 12% bracket now becomes 15, 22 becomes 25, and you can see the dollar amounts are slightly different as far as where they start and end. But notably, you can see a additional bracket now with a higher, I should say a higher bracket, 39.6. That was the old high tax bracket back in 2017, and the 506,000 odd number, that is where it ended in 2017. So you can see we're going to get there faster, besides paying a higher, about average 3 to 4% per bracket. So nothing scary, but it's sizable dollars enough that will make an impact. And I know I just had a tax planning meeting yesterday, and it's anywhere from a $15,000 to a $20,000 hit, if we go to this new proposal for my client who's in that 25% bracket. So it's real dollars. Next slide, Amy, please. Here are a few more things. If you are an individual earning over $5 million, there is going to be a surtax on the dollars in excess of $5 million. That's a large number. I don't know what our people on the call fit, but Kurt said that's going to hit him really hard over the $5 million number. So we're going to have to work through that, and hopefully that doesn't pass for him. SALT tax, that's the state and local tax in 2018. If you're an itemized deduction person, you know that state taxes are something that you can deduct. And in our great state of Minnesota, in the top 5, highest taxing, states in the union, that was a very important deduction for a lot of people. And that actually made a lot of people, quote, itemize. As you're familiar, there's a standard deduction now of about $25,000 for married filing joint. And you get that as a God-given deduction unless you have deductions that add up to greater than the $25,000, which state tax is. Currently, we're capped at $10,000 of tax deduction, and they are talking about removing that through 23. So I think I'd love for that to come back. However, it does create some AMT issues now and then, but please, that's coming back. Another notable, the top tax rate, 26.5%. It's currently 21. That'll impact a few people. And one item, the very last item that I'm not very pleased with, is this net investment tax of 3.8%. Historically, that was only on investment income. And it's looking like they're going to add that to all business income, including the investment income, if you happen to have an AGI, adjusted gross income, over $500,000. That one is going to hit a lot of people if that comes into play. Our small business owners are going to have some issues with that. So I hope that doesn't happen, but that's currently what's on the docket. Next slide, please. This is the capital gain rates. As we sit today, on the left side, you can see if you're in and you fall in those various brackets, we've got basically 3, a 0%, 15%, or a 20%, depending upon the brackets you're in. And again, this is for your long-term capital gains and your qualified dividends for that matter. What they're proposing to the right, if you're in the 0 to 15% bracket, you're going to be in a very similar position of 0. But if you go to the 25 to 33%, same 15, the 20% stays until 35. And now if you hit the highest bracket, income tax bracket of 39.6, you will be in a new 25% long-term capital gain rate. So that is, again, a material change. And again, this is on the federal side. So again, raising revenue to try to pay for some of the bills that are anticipated with the infrastructure and whatnot. So next slide. And then finally, the estate side, we've been hearing a lot of stuff about that. You'll notice on my slide, the step up in basis that you've been hearing about, where if you pass away and you pass assets on after you pass away or in your estate, you get a step up in basis, meaning mom and dad bought farmland for $1 million and now it's worth $6 million. The beneficiaries get the step up in basis, and they were talking about taking it away. I'm very pleased to say I think that's dead on arrival. That's not going to happen. So I do not have it on my slide. But the things that are changing is the actual lifetime gift and the estate exemption. Currently $11.7 million per person is now going to be reduced to about $6 million per person, or as Kurt and I had mentioned, 11.7 if you're married filing joint, more than likely is where it's going to land in total. So it's about half of what they are anticipating going forward. A big change, a big reduction, but a lot of folks will still be pleased with getting the 6. There was even smaller numbers that were being talked about, down to the 2 and 3 million. And I think if I have to compromise, I'll take that, but certainly like the 11.7 per person better. Second, a lot of our more high-end or complicated estate plans have grantor trusts to avoid the transfer, if you will, and the gain on the transfer in. They are talking about removing that opportunity. That's still in the books right now, and that would dramatically change the estate plans out there and have to work around some of that. The unfortunate part is that a lot of these provisions are being talked about as being approved and effective for 21. The unfortunate part is obviously we're in 21 and we're already 3/4 of the way done. If you've got these things established, how do you unwind it? Yes, it creates a lot of problems. So we're hopeful that they're going to at least go to 22 or make it something forward thinking if they pass it on November 1st, anything after that date. And Kurt and I had talked before the session started that, it's not a great time to be a planner because you can't plan. And you're in the middle of a year, you might have done things in April, and now you can't unwind. So it's really unfortunate if they do that. So we're hopeful that it's going to be a 22 issue if it does get passed. And lastly, there is a 3% surtax on trust income over 100K, which kind of lines up with the $5 million surcharge we talked about before. So that was where we're kind of sitting. Again, it's a lot of changes, nothing too scary, but nonetheless very material. I don't know, Kurt, did you have any thoughts you wanted to address on how you see it as a financial advisor?
Yeah, I mean, well, thanks first of all for everyone for having me. Yeah, I mean, we were talking before the call, Joel, and I think the question I'm getting the most is timing. Even though people don't know, we all don't know for sure what's actually going to make it through to the final bill. We have some presumptions on things that are, have been taken out. It always starts off really scary and then it seems to back down, but it's still negative for a lot of our clientele at the end of the day. But things like removing the cost basis, that was a big one that would have made all of our lives a lot more complicated and caused a flurry of activity depending on how and when they made that effective. But so it's getting better than it was, but it's certainly going to come with a lot of work and challenges. But the common question I get is timing. Is it possible that some of the items you went through have different timing amounts? Like they talk about having the tax brackets go back to the beginning of the year or be effective for 2021. But the estate planners are going to have the brunt of this. I mean, your job's going to get a lot worse than mine, and the estate planners are going to get a lot worse for sure. If they are successful in keeping the removal of like all types of grantor trusts, idiots and slats I think would be included in that. Those types of things. I don't think that they're proposing that existing ones are going to go away, but future created ones are going to go away. So that brings into question, it won't be allowed in the future, or they'll be allowed, but they're kind of pointless, right? If you set up a grantor trust and it doesn't remove it from your estate at death, it kind of defeats the purpose. So they'll just be kind of irrelevant. So my question to you is, have you heard anything about the timing on things like that? If we wanted to establish a trust, create it and fund it before the end of the year, is it still possible?
Yeah, great point. My understanding is it's going to be, at a minimum forward thinking, because you can't go back and unwind that stuff. It'd be detrimental. I know our great state of Minnesota has done a lot of retro stuff, but I think in regard, Kurt, I would envision it being going forward. My hope is that we're going to have at least, a month or two to get it figured out. If we do want to do a whole bunch of funding to get this done, I do believe, don't know for sure, but I do believe we will have that opportunity to do that. The tax brackets, that could go retro. The problem is for W-2 earners and their tax withholding, and if they're short or estimated payments, how does the IRS deal with interest and penalties, right? I mean, you can't charge a penalty on something that a taxpayer didn't know. So I feel like anywhere you go to make it retro, there's going to be a negative. They're going to have new laws to say, all right, we're going to pass on penalties for a year, or we're going to defer this for a year. So to me, the easiest, which you could probably agree with, Kurt, is making it prospective, go to a tax year, make it in its entirety instead of doing something in the middle. give the world a chance, you know, if it's a quarter, if it's a year, whatever it is, that period, give them a chance to get all their ducks in a row, be a good soldier, be a good citizen, and I'll follow the rules, but give me time to get ready for it. That's my hope.
Yeah, well, one can hope. I've had the question about people setting up grantor trusts, like, hey, if it's effective, the word was that it might be effective as of the passing of the bill. So that could be, that could be in a couple of days, that could be in a couple of weeks. I would say at best it's a couple of months. So, you know, if it were effective on the passage of the bill and that were in November, then you would have to actually be able to, if you were thinking about doing this and talking with your professionals, or for the professionals on the call, if you're talking with your clients, you know, you might want to think about seeing how quickly you can get that established. It might come down to literally dating it a day or two before and having it funded and created a day or two before the bill's enacted in order for it to be effective and still stay out of your gross estate. So just, yeah, this stuff is complicated. It's really a tough time, but
yeah,
I joked, I said, I'm glad I'm not a CPA this year. And Joe said this year, he goes, like 3 years, right? That's the last 3 years has been just it has been a crazy time. And you mentioned it's not the state. I mean, it's the state as much or more so than the federal that causes headaches for everyone. So
as of late, for sure. I mean, Minnesota made it really hard on all of us as taxpayers and as, you know, tax preparers. It's been a challenge for 3 years. Not that I'm complaining. You know, having new work is always good, but it takes time to get all that stuff done, and there's only so many hours in the day, you know. So
great. Well, maybe we can segue into the rest of the presentation. What we hoped to do today was to just kind of walk through some tips and techniques and things that are real common for us to be talking with our clientele about, especially when it comes to year-end giving. We've done these, the Community Foundation's done these, I think most years. Year-end planning. Year-end planning is broader. Year-end giving gets a little more specific. So we're trying to focus our things into ways to think about gifting to your community foundation, to your donor advised funds, to directly to charities, however that might be, in the last quarter here as we go in. So maybe I'll just kick it off at less of a technical topic, but we thought a good place to start off as a reminder is using the folks around you. So we have a mix, I think, on the call of professional advisors, estate planners, CPAs, tax professionals, financial planners. We also probably have some donors on the call, and so the messaging can be a little bit different. But if you're an advisor trying to get proactive and push out messaging to your clientele to utilize your knowledge and your experience and your services that your firm brings, if you're a client or just an everyday person who has a CPA, has a business attorney, and estate planner, has a relationship with the folks at the Community Foundation, we're all great resources. Your financial planners are all great resources, and I don't think that our clients use us enough when it comes to year-end planning. It's a lot of hindsight and things like that, and oftentimes we can push out material, but it gets buried. It's difficult to know who needs what at the very end of the year, and so I just encourage you to remember to utilize your relationships with professional advisors as much as you can. Everybody's got a great idea toward the end of the year, and so reach out. And the Community Foundation as a whole is just a great resource as well to learn a lot. And even for folks like Joel and I continually learn from people like Greta and Steve, and new techniques and new trends and things that are happening in the industry. So make sure to reach out and use your advisors. And I guess from there, I'll pass it back to you, Joel, and maybe have you start off talking a little bit about some of the techniques that we use at the end of the year with our clients.
Yeah, amen to that, Kurt. I appreciate that segue. Planning is super important and super time sensitive, right? There's a lot of things we cannot fix if the year end rolls over, right? Most of our clients are year end, calendar year end people. And all of a sudden they give us a call in January, Kurt, and they want to do something with their charitable giving. More than likely it's too late, right? So it's kind of a time sensitive deal. So to reiterate how important it is just to meet with us, but timing is critical, right? We want to make sure we get to visit with you in December. I'm sure all the executive directors on the call really appreciates that last second on New Year's Eve. I need a deduction because I just talked to Joel and the CPA. I got to get that done. Probably hard to do, right, at year end and when you're getting that close. So yeah, back it up. Meet with us in November, December, and we'll get you on its path. Talking about strategies, a very common approach is something we call stacking of the deductions, where we kind of add things together and bunch them up. Okay, and years ago, when the standard deduction was only $12,000 for a married couple, now it's $25,000. Okay, it was very common if you have your giving, if you normally give, $5,000, whatever it is amount per year, and you didn't have enough other expenses to itemize. So those are like mortgage interest, state taxes I mentioned, charitable donations. That's the big three, right? And if those three don't add up to greater than your standard deduction, which now is $25,000, you are a standard deduction person. You don't itemize. So if you're giving your $5,000, maybe even $10,000 a year to your charitable organizations, it may not be enough, and you're not getting a true benefit. So what we often do is say, all right, look out into your next coming year, and if you are planning on giving another $5,000, let's bring that $5,000 into the same tax year and basically have 2 years of giving in 1 year, and allows you to stack, and it allows you to get a benefit maybe beyond that itemized or the standard deduction amount. It's getting harder to do with the 25 grand now, again, with the tax law changes starting in 18. Still an opportunity, harder to get there. So the dollar amounts have to be bigger unless you are, again, have a lot of mortgage interest. And if they remove as I mentioned earlier, the state tax cap, if that gets removed and we can now deduct more than 10 grand, then I think this bunching really comes back into play. Before it's been hard to do that because the dollar amounts have to be so big to get to that 25. If that does change, I think that's going to be a very immediate thing that's going to happen, is that we're going to start seeing more folks bunching and getting all that done. And again, working with the community foundation, that's a great opportunity to work with the foundation to get some of that bunching. If you don't know where you want it to go, you don't have an exact organization, that donor advised fund ends up being a great tool, which I know Kurt's going to talk about more later, to do that bunching with. And to do it right and get it timely done. So that's a very common strategy, nothing magical, except it takes that visit with your CPA, with your attorney, with your financial advisor before 12/31. And I'm sure Sarah Carlson, my friend out of Willmar, I'm thinking 10 days before year end is something you might want to have that much time in advance. And I don't know if you want to comment on that now, Sarah. That'd be awesome if you could.
Sure, I'd be happy to. Thanks, Joel and Kurt. As a rule, we do like to have a few days time to get a fund agreement ready and to make sure that we're giving the right advice to the donor on the assets and on when they get distributed, so that it's not just putting it in. Do we understand what they want to do with them, and do we have the fund ready? As a rule, we usually say stock gifts need to be completed before Christmas. That would make sure that we have enough time for those to be executed in transit. Whatever days the market is open or closed are not necessarily a problem for us to conduct that business at the end of the year. But we are busy usually those last few days of the year with kind of that last minute decision that's been made, or the advice from their professionals is to get rid of a capital gains issue, make a gift now, do that kind of work. It's important that the professional advisors know that they can make a quick phone call to us and just smooth that road out for the clients who will become our donors, and just give us some heads up about what they're thinking, what they're talking about, what kind of asset is going to be coming, so that we can give the best advice back. We want to be a good teammate with you all as advisors, and we want to be the best assistants to our donors. So kind of have that in your mind, that before Christmas is the optimal time for us to make sure that we can execute. But as long as a gift is in our hands, postmarked, US postmarked by December 31st, or is in the hands of the staff by the 31st, it should qualify for a deduction during this calendar year.
Awesome. Thank you, Sarah. Whoop, that was loud. Thank you, Sarah, for jumping in there like that and talking about the stock transfers. I know, Kurt, you were going to talk about some of the cool things you can do with the appreciated stock.
Yeah, I mean, I think it's worth, Sarah alluded to gifting stock. This idea, it's worth this kind of reviewing a really simple and common idea that most of the professionals on this call probably already know about, but I think it's worth reviewing, and that's just thinking through the gifting of highly appreciated assets. So it doesn't have to be stock. It can even be business interests, real estate. It can be direct mutual funds or ETFs. It can be any sort of investment that's highly appreciated. There's no rule that says you can't donate a position that's not appreciated, but it just takes away all the luster. So the leverage that comes from donating something to charity or to your community foundation or to your donor advised fund, which I will spend a little more time on here in a few minutes. But the leverage part is one of the reasons it works so well. So, if using stock, for example, if someone buys 100 shares of something at $100 a share and they've got 10 grand into it and it suddenly is $200 a share, if you can donate that stock, a few reminders of things that matter here. One is the leverage part of it. And what I mean by leverage is really you're taking something that cost you $10,000 and you're donating $20,000 and getting the full $20,000 deduction if you're doing it correctly. So it's the cost versus the amount of deduction benefit, but then you're getting that full deduction on top of it, and you're avoiding the gains that you'd have to pay, capital gains tax you'd have to pay if you were to sell that and realize the 10 grand in gains, and then donate the cash. And it's again, I know there's a lot of professionals on this call that probably totally know this, but I'm assuming it's no different for you guys. It is really, really common for us to see our everyday clients come in with lists of their donations and things they've given in cash, just in writing checks. And I gave my church $5,000 this year. Oh, cool. How'd you do that? Or I wrote them a check, or I put it in the envelope or whatever. And meanwhile, they bought Tesla 3 years ago, and we could have just donated some of that and had so much more bang for their donation. So it amounts to either them being able to donate more to charity or them to use less of their dollars to get the same amount of deductions. So the leverage is huge. A couple things to remember: in general, the appreciated asset does need to be held for a year. And then to Sarah's point, a good reminder is stock gifts and take time, and real estate gifts even take more time often. So these are things that you don't want to be thinking about. I even say in December. I think this is fourth quarter stuff. Right about now is when we should be talking to people about these ideas and looking at them. And it needs to be a year-round message, because they give when people ask often, and not necessarily just at the end of the year. So thinking about it year-round and educating our clientele about the idea of gifting something that has a low basis is just such a fantastic thing. And and obviously, but it should be noted, don't liquidate it before you transfer it. You can't do that. You have to transfer the actual piece of property to the charity and let them liquidate the stock, the mutual fund, the ETF, or it doesn't work. A little bit of a jumping ahead to my DFA, my donor advised topic, in a second, but in conjunction with appreciated stock, if you have a donor advised fund through the community foundation or elsewhere, it is it's also a super easy thing to do. Imagine transferring one stock into your DAF, into your donor advised fund, and and then they liquidate it, creating this pool of money, and then you can recommend that they send it out to various charities, to 5 or 6 different places, instead of you trying to organize one transfer of a couple of shares to the church and one transfer to Catholic Charities and one to United Way. You can just put it simply into your donor advised fund and let the community foundation help you with those transfers. So it's an easy thing to do if you have the combination of gifting highly appreciated assets along with a donor advised fund. And the other thing is you get the future growth in the donor advised fund. If you don't gift it right away, it can be invested by the professional organization that's running it. And you can continue to then grow that gift before you dole it out. So those are kind of the ideas there.
Yeah,
so Joel,
excellent.
Yeah, go ahead.
No, I didn't mean to interrupt you, Kurt. I'm sorry about that.
Yeah, I was just gonna pass the torch.
Yeah, you said it beautifully on, you not only, it's a double win, you get the deduction opportunity and you don't claim the income. You're right. It's a double win. There's no reason not to do it. And it does take time though. So
but people do it all the
point.
time, right? I mean, people donate in cash and checks all the time.
Yeah.
And it's not really any more work to do a $2,000 gift than a $20,000 gift of stock. We do it all the time.
Right. So very powerful tool that's overlooked a lot. I totally agree. Another one that has, because of the higher standard deduction, has really grown in popularity is the qualified charitable distribution. And that is something that ties in with your RMDs, your required minimum distribution on your IRAs. And that's obviously the first criteria. You need to have an IRA. You need to be 72 years old. And kind of this double win, you have the opportunity to do a direct contribution from your IRA to a charitable organization. And the beauty is, if you're not itemizing, meaning we don't have enough deductions, right, to get above that standard deduction, you then use this qualified charitable distribution and you do not have to claim it as income. Normally, of course, IRAs, traditional IRAs are coming out. They are ordinarily taxed at your rates. We had shown the brackets before, anywhere from 15 to 39.6%. If you are not itemizing, again, we can take this direct distribution to your chosen organization. Again, you make that choice, and you can do this year after year, and it actually satisfies your RMD as well. So you're getting a double win, right? You're required to take out so many dollars based upon your life expectancy in the whole actuarial chart. This actually counts for your RMD. It goes directly to the charity, and you do not have to pay tax on it. It's like the trifecta, man. It's like it's a great thing. It's been used a lot more. I've been communicating it as much as I can. It does take coordination, right? You got to talk to your advisor, Kurt. I don't know if they all wait till New Year's Eve for you guys to do that stuff, or if you have to do that in the beginning of the year. I certainly want to hear your take on how that works to make it most efficient, for you. But tax-wise, it is a beautiful thing, and a great part. In addition to having all these things, you can actually do up to $100,000 per person. So if you're married, that's $200K. And I realize not a lot of people give that much in a year, but it's an amazing, powerful tool that you can do this year after year after year. And you just have to do it annually to call your advisor to get this done and make it work. Now, the one caveat is, to make the QCD work, you cannot direct that to a donor advised fund. It has to go direct to a charitable organization. So that's one thing, a nuance that not everybody knows. If you're going to do this big bunching and I don't know where to go, maybe I'll just do a QCD of my IRA and bring it over to a donor advised fund. That does not work. So that's just one small negative. But how does it work in your office, Kurt, when people want to do this? Do you recommend them calling right away? Can they call at the end of the year? How does all that work?
Yeah, it's usually pretty easy. It does depend on the custodian, where the assets are held and where the IRA is. But most of the big custodians, the Fidelities and Vanguards and Charles Schwab's of the world, are doing thousands and thousands of these, and so they've got it down pretty well. And the key is, again, kind of like the highly appreciated stock or something, to make the transfer directly out of your IRA. It cannot hit your hands. It needs to go directly to the charity. Mm-hmm. But another tip, and maybe someone here maybe Sarah or Steve or someone can come in and talk about this, but you know, this note of the donor advised fund not being allowed on QCDs is true. And we get that question a lot. I've actually seen people try to do it. And it's a mess if you do. So, but you know, if you're in a partnership with your local community foundation, they can act as a 501c, right, Sarah? Like you can direct your gift to the community foundation, maybe not directly to your donor advised fund, but then ask them to make the gifts directly to the charity you want through their 501c designation. And maybe you can elaborate that, Sarah.
Sure. So we work with donors all the time who want to do IRA rollovers or QCDs, and they can't put it into their donor advised fund for all the reasons you have already said. But that doesn't mean that we can't help them. We can assist them in establishing a scholarship with those assets. They can establish a designated fund that supports their favorite charities in an annual payout each year. That's allowable. They can actually establish a fund that benefits their favorite charity and is an agency fund or a field of interest fund. So we do have other tools that are allowable by law for those kinds of gifts to come to us. Now, on rare occasions, we will act as a pass-through, which is what Kurt was just mentioning, where we might take an asset and do it in a pass-through way, but that should be discussed with us, and it has to be something that makes good sense. For example, we might already hold an agency fund that they ultimately want to benefit, or the agency they want to benefit cannot take gifts of appreciated assets like that. They just don't have the bandwidth, or they don't have, it's all volunteer led. So it has to be a relatively unique circumstance where our 501c3 would act as the pass-through agent. But more common is for us to tag in with a different kind of fund that still executes the charitable intention of the donor and is allowable by law to use an IRA asset.
Great, yeah. So that's so QCDs, you know, they're not used often enough. It's really a shame to see a tax return come into my office when we get a new client. One of the things we do is request their last tax return and review it, and it does happen quite a bit, unfortunately. And I think it's our jobs to be educating our clientele about this kind of stuff, where you see a person who donated $10,000 and had $20,000, you know, a required minimum distribution on their tax return, then they didn't get the deduction because it was under the standard, and they paid tax on the RMD and still made the donation, and it's you know, it's unfortunate to see those things happen. So it's just something we got to keep top of mind.
Another win with that, Kurt, if I could jump in tax-wise, by pulling that RMD off of your adjusted gross income, the Social Security, sometimes if people are in that bracket where it's maximum taxed at 85% of its value, if you're at that cusp where it starts escalating, and that could be a difference maker. If you pull that $10,000,
Yep,
you know, contribution off, that RMD off, it could save even more money, you know. So that's where that planning, you know, again, the timing of it. And if you know you have a client that's in that bracket that could offer that is a win, because there's a few, you know, or tax credits, or there's a lot of things that are based upon an AGI number. And if you lower your AGI, adjusted gross income, you may have an opportunity to gain other things that are like the gravy, man, right? The frosting on the cake, right? You're already eating the cake, you love it. And all of a sudden now it's like even better because now the frosting went that thick, you know? So, I mean, it's just a lot of wins there, but it does take planning. So
yeah, you get phased out of stuff, right? I mean, the higher your AGI, you start
out.
getting phased out of child care credits and child tax credits and all those sorts of things couldn't come back in. It's absolutely right, depending on where you are.
Yeah.
Well, Joe, let's take the last section of our discussion and just kind of fill in the blanks. We talked a lot about donor advised funds, but let's fill in the blanks a little bit around that. It was interesting is trying to come up with these topics and ideas, is they're all intertwined. It's almost impossible to talk about gifting highly appreciated assets without mentioning a donor advised fund and or even stacking your deductions, bunching your deductions. We love donor advised funds. one of the, some of the basics first, right? You can go to your local community foundation or other sources, and you can create a donor advised fund in your name. And what you're doing is creating a place to donate money or assets and get a deduction the year you do it. And you can, it's flexible. You can contribute to them as frequently as you want, but you don't have to name where those dollars are going. So the sponsoring organization, does control the assets and they invest the dollars. I mentioned that earlier. So you can get, if you don't make a gift out of your donor advised fund, you can get future growth on those dollars before you make a gift, tax-free future growth, which is amazing. But you can direct the gift. You can recommend to the community foundation to make gifts to certain places at certain times. And, the vast majority of the time they will follow those recommendations. But legally, they are in control of the assets. It is an irrevocable gift when you put it in there. So it does get it out of your estate. So it's a fantastic way to lower your estate. If you're worried about estate taxes, as Joel talked about in the beginning of the call, those limits are going down. Those exemption numbers are going down. And a little bit off topic, but one of the things that I was thinking when you were talking about these exemption amounts jumping down by half virtually is, it's still a lot of money, but there's a whole segment of people that didn't worry about it because they were so far under in their minds the 11.7 times 2 people 20 million, so they were so far under it that they haven't been thinking about it now for a couple of years, and they might be brought back in. They might have more than the limit now. That segment in the middle, if you were always under 5 million, you probably really haven't thought about it ever before. But if you were at 5 or 6 or 7, you were so far away from thinking about it before, and now all of a sudden there's a segment of our population, our clients, that we need to be thinking about that are going to have an estate problem if this bill goes through. So donor advised funds is an easy way to dump a lot of money in, get a deduction now, make your decisions on when to gift later in flexibility, allow those assets to grow. And one of the things that I like to think about, and I recommend just kind of putting in the back of your head, is one of the biggest times you should be thinking about this is in an event, like a major taxable event, right? So we have clients who maybe sell their business. They're retiring, they sell their business. This is all of a sudden they've had a nice income every year, and then they're going to just have this crazy high tax year because they have to realize a whole bunch of cap gains or whatever it is on a business sale or a building sale, piece of property, something like that. And those are the greatest times to do this. Like, so you have the money in that year to give away, and you maybe don't want to give away all of it right now, but you're going to get the best tax bang for the buck if you're sitting in those highest brackets by bringing those things down and hopefully even capturing some more of the credits and things like you were just talking about. So we really like to be aware of those moments in time where our clients are facing 1 or 2 really bad tax years. These are the times to pre-fund. So the way I talk to my clients about it often is, how much do you think you'll give away in your first 10 years of retirement? And the client says, well, we usually give away $7,000, $8,000, $10,000 a year. So I said, okay, so you might give away $100,000 over the next 10 years, right? Reasonable? Yeah. Well, let's put $100,000 into a donor advised fund right now this year and take it off your top bracket. And then it'll sit there, and you've basically pre-funded your gifting for the next 10 years. You don't have to worry about it. Someone else manages it. Someone manages the money. Someone manages the distributions to the charities, and it's all pre-funded, and you're getting a way bigger bang for the buck, especially if it's a sale of a business or something, and then they're jumping right down into a lower bracket for those next 10 years. You're just never going to get that much of a bang for the buck. So it's kind of like stacking, right? It's similar to that, but just trying to get it all lined up in the right years. And you can even do that with your stacking example every 3 years, right? Like take my normal standard deduction, take my normal standard deduction, and then do all my donating in one. Well, you could just do 3 years worth into your donor advised fund if you don't know what else to do or you don't have any asks of you at the time. So those are great. The tax benefits are great. The flexibility is awesome. They've just been growing in popularity immensely the last 3 years, I think. And you can donate cash, you can donate publicly traded securities, stocks, mutual funds, ETFs. Even non-publicly traded assets are available in some places, like private business interests and things. You do have limits, right? There are limits to donations. I think we get, and Joel, maybe you know, but 60% of your AGI is a limit of a deductibility on cash like things, where appreciated assets are limited to 30% of your AGI. Is that correct?
That's correct. Yeah.
So, you do have to be aware of that. And again, it's why we use people like us. You need your professional advisors in Hall to do these things. But yeah, they're just kind of no-brainer tools. And I really wished I would have used them much earlier in my career, because most of the clients that are using them now are because we brought them up. They're not because they came in and already had them.
Yeah, no, I totally agree. And even in our community with the Willmar Area Community Foundation and Sarah's involvement and just her selling and being out there and about and the confidence in it. I think when I was a younger CPA, you heard about them, but it sounded like voodoo, and we didn't have a foundation that was as powerful and as, out there as what we have today. And that was no offense against the foundation before. It's just in our community, I mean, WACF stands tall, pretty tall, and that brings a lot of confidence to it. And it's like, okay, I'm giving up $100,000 in your example because I had this big win. That's a good deal, but I still want it to go to a place where I trust, right? And that's a lot of money. And the Willmar Area Community Foundation has just grown immensely, and that's for the most part under Sarah's leadership. So she had paid me to say that real quick, so I got that in. She's smiling. She did not pay me for that. But I think it helped the confidence, right? And it helped me use it more when I have a powerful partner, in the foundation that knows exactly what they're doing, professional about it, discreet about it, and has done a million of them, so they know how to do it. And I agree with you. In my younger days, I knew about it. It seemed a little bit sus, a little suspicious. Like, does that really work that well? And it does work that great. You're right. It absolutely does. And it is literally the first thing on the list for us when you have that event, like you said, that big event, Kurt. It's automatic. Like, do you have a philanthropic interest? Do you have something you've always wanted to do, but you never had the cash to do it? Now you do. Now's the time. And
they love,
Sarah, go ahead.
Yeah, and Sarah, they love talk. I mean, you guys at the Community Foundation love talking to people about this stuff. This is your passion and your job. And so that's the mistake I made. Younger version of me was maybe intimidated or didn't really know what I didn't know. But for those of you on the call that are maybe early in your careers and just starting out, I'd encourage you just to reach out to the Community Foundation and ask for a sit down and just learn more about these things, because you don't have to be an expert in donor advised funds to be able to recommend them to a client. All you have to do is be aware of the right timing and situations of when they might work. And then you can say, I don't know that much about them, but I know a partner in town locally that can help us get this done. And then you can just bring them in and leverage their knowledge. That's what I should have done more of earlier. And it's just such a great resource to have this growing this growing community foundation in all of our communities now.
We love being invited to the table. We know that you guys hold the first relationship with those clients, and we want to back up that relationship that you have been building and stewarding with the best expertise we can bring to the table. So you guys have hit on one of the things that we believe at our core here at the Community Foundation, and that conversation matters, and having repeated conversation matters. So yes, for all the advisors on the call, please call your local executive director. There is no question that is silly or that we are not able to answer or get you the answer for. Sometimes we get the opportunity to learn too from a unique circumstance that your client is in, and then it informs our practice as a whole, and we can provide better customer service across our entire footprint. So please do reach out to us. We do firm visits. We'll do presentations for your firm or invite you to come and talk about this kind of thing. Donor advised funds are a big part of our portfolio, and we are good at it. We provide concierge level service to those donors so they get exactly what they uniquely need, each fund at a time. So we appreciate the trust that you give to us, and we hope that we can earn that trust with your donors as well.
Great. Well, I think that wraps up our major topics, Joel. I mean, I think that wraps up our major tips we wanted to get across. Maybe we can hand it back to the powers that be here.
Yeah, for sure. I think we're actually a few minutes long, so we did great. Good stuff.
Right.
Well, thank you both so much for being willing to offer your expertise today. We appreciate it. We do have a couple of questions in the Q&A tab, so we're going to start with those, and then I've had some chatted to me as well. So earlier, you guys were talking about the kinds of grantor trusts and things that are now might be intentionally defective. Is there one of our questions is, would old grants and intentionally defective grantor trusts be grandfathered in the new or in the current scenarios?
Sure. So what we're missing in this group of professionals here for sure is a great estate planner. And I think an estate planning attorney who's probably more up on this than I am, but I was talking with one that I hold in high regard, and she had people in her firm actually listening in on some of the topics out of Washington just this week. And their take is it's going to be forward. I think Joel said it before. I think if you try to say that all of a sudden all grantor trusts are or idiots or spousal lifetime trusts, if you just tried to say they're all now part of your estate, you would cause it's not like excuse me, it's not like you'd cause havoc like you would if the cost basis piece went through. It's like literally not repairable. So I don't know how they could do that. So my short answer is, best guess right now is that they will be effective the day the bill goes into effect, is what she told me. Best case scenario is they might make it a future in the bill, like January 1st or something, and give you a little time to get one set up. I kind of buy what she's saying, which is it's probably going to be effective the date of the bill. She was like telling me that if you have a client you're talking to about a grantor trust, get it done, get it written, get it funded, because if the bill passes on Thursday, it needs to be dated and funded by Wednesday to be effective. But yeah, I don't think they can go backwards.
I would agree 100%, Kurt. Yeah, it would be very detrimental and almost impossible, I think, to force people to back, because you can't unwind it, like you said. I mean, there's no repair to it. So the hope is that it's going to be forward thinking at best, effective forward, not retro, and hopefully in another tax year.
To me, it's the biggest part of this bill that's a mess next to the cost basis thing. So since they've kind of killed the cost basis push, I'm hopeful that the lobbying efforts of the estate planning community and things are, I'm hopeful that this is the next thing that they'll give on, and maybe it doesn't go through, because it just sounds, awful. But if it, it is what it is, right? We're in these jobs and we're not in Washington for a reason. So we'll deal with the rules as they come out. But I'm crossing my fingers that it gets cut or reduced in some way. I can't imagine taking them out. They're basically just, the proposal is to make them includable in the grantor's estate. That's the proposal. But we all know, if you think through what that means, it essentially makes them not a very useful tool. You're just creating a normal revocable trust. So it'll be interesting to see where it comes out, but hopefully it's not there at all.
Thank you. There's a clarification question also about cash donations, and wondering if for 2021, if cash donations have 100% AGI limit. Joel, can you help with that?
Well, I'm going to try to do, oh, I'll wait there. Trying to do some research here, and I thought it was just for 2020, but how about I do a little quick research and I can get back to you guys? And
Sure. I have a question that I
apologize.
can start with Kurt on while you do that little
Okay.
checking, Joel. Thanks so much. So Kurt, you talked a lot about donor advised funds and why they're on the rise. Do you think that that trend is going to continue, that we'll see an increase all the time each year in donor advised funds? And what are the most common assets that people are asking for into a donor advised fund right now?
Excuse me. I've been managing to hit mute every time I cough. I'm at the tail end of a cold. What are the most common, I'm starting with the last part, the common assets, like, the assets really that go into it can be anything. We see people donate everything from cash to securities or whatever you want, short of the asterisk of you can't use your RMDs out of your IRA. But yeah, the popularity from what I've witnessed seems, you'd know more than I would, Sarah. I mean, it seems like they're growing immensely. The numbers certainly dictate that the last 3 or 4 years. I think it does have something to do with our tax situation as a whole. I would bet if taxes are going up, and they're not talking about donor advised funds that I know in this bill. So it is one of the tools that will survive that we can use to effectively do 2 things, 3 things. The most important be gift money and be charitable and philanthropic in nature, and do it with getting large deductions that are helpful from a tax standpoint, but also reducing your estate. So I would guess if the estate federal exemptions go down, you're going to see more use of this, because it's just a really effective way to reduce your estate immediately today while you're alive, and still have some impact on where those dollars go, and not have to blow them all out the door to charity in one day, right? It's not writing a check for $1 million. It's pre-funding hopefully years worth. And you of course can, as a donor, I didn't say this before, but as a donor setting up a donor advised fund, you're able to create not only direct recommendations for your beneficiaries of the dollars, but also name a successor to you. So when you pass away, if you want someone else to run it, you can do that, or the community foundation can run it for you.
Right. Or we'll do a final payout, or we have a number of different ways that we will assist a donor in doing that kind of work. I would fully imagine we will stay very busy with the donor advised fund tool in our toolkit. And again, just if you are a newer advisor and you're not as certain about how a donor advised fund works, please just give us a call. We are happy to explain that. We're happy to give you connections to donors who are currently using funds and have had funds for a period of time, so they can tell you how it feels to use those. You may even have some of your clients that have them with us and you don't know that. So we'd be happy to be your partner in understanding how a donor advised fund works. One of the best parts about a donor advised fund is you don't have to have a pre-selected plan for every dollar that comes into a donor advised fund at the time that you set it up and fund it. You can have time to make the decisions about what you want to do. Maybe you know a little bit you want to give away now. And as Kurt mentioned, there's a project that's percolating in the community that aligns with something that's really important to you. Your alma mater calls and says they want to do something that really is important to you. As long as there are assets in the fund and it's a qualified recipient charity on the other end, we can assist with the donor advised fund over time. Many of our donor advised fund holders have been with us for years, and they just keep repopulating their fund whenever one of their advisors tells them it's time, whenever they're getting low or they have a taxable event, and we continue to work with them to do their charitable good in the community. It's really our honor to do that. Joel, it looks like you maybe have done your research. What would you have to say about that clarification?
Well, I'm apparently wrong, or we were wrong. I guess it does go to 21. So I I thought it was just for 2020, and ironically, I went to the IRS website and it clearly says contributions through 2020, but other sources, so they obviously haven't updated that yet, but it does look like 2021, you could do 100%. So my apologies. Christopher, I think, was the person who brought that up. Thank you for the clarity. And again, my apologies for blowing that one. So I'm going to go quit my job today and I'm going to start farming full time. So good stuff.
I'll be over shortly to talk you out of doing that.
Okay.
So thank you both. This is a great example of how we learn. We learn as a community of professional advisors and of allies who work with clients. And so thank you, Christopher, for pointing that out for us so that we could correct that and we all walk away learning a little something today. I appreciate that very much. One question that was chatted to me was, do either of you have any advice about strategies you found particularly effective to talk with your clients about charitable giving, especially if the client doesn't bring it up first?
You want to go first?
Sure. I guess for me, the easy in is, do you want to save tax? Right. And I'm not saying you should be philanthropic, only because you want to save tax, but that's a very easy angle for me. Right. So in my industry, my clients are always, I want to pay my share, but no more, right? So if there's an opportunity, I expect you, Joel, as my professional CPA, to help me with that. So for me, that is usually my intro. My first step is, all right, you had asked me to find ways to save tax. These are things you can do. Historically, you've been at this level of contributions, we should bunch. Or I know you're going to be selling your business in 3 years, we should talk about a donor advised fund. So to get the deduction. So for me, it sounds maybe bad that I use tax as my number one and saying, instead of saying philanthropically focused and heart, God loveth a cheerful giver, right? But God also knows that we should pay our fair share, right? So, that's how that kind of works. That's my angle. I don't know what Kurt finds in his business.
Yeah, honestly, ours is probably a little more on the touchy-feely side. When we're doing discovery sessions with new clients, or even have a client that has all of a sudden a big event, a retirement, a sale of a business or a building or something like that, where they come into money and they haven't been charitably inclined for the most part, we'll always bring it up because there's a tax angle, but we'll bring it up with new clients every time just to get a sense of where they are. I sometimes think that people would give, but don't really have anything right in front of them flashing like that is driving their passions, right? So sometimes just having discussions with their clients about it, like, hey, do you give? It's fine if you don't. Like, my job is not to be a judge of character. My job is to help my clients achieve their goals. So if one of their goals is to pass every dime they have to their children and never give any of it away, that's not my job to judge them, but to educate them around the power and reward of doing so is huge. And so, we're doing that with a client today because the parents were charitably inclined, but the kids are going to inherit a lot of money. And so we're going to set up charitable funds for the kids to run, to teach them the value of giving, instead of giving it right to the kids and telling them, make sure to give something back. They're going to designate it as charitable only and let the kids run it and decide where to give it away. But so there's a lot of ways to do that. I think just telling stories with your clients about, I gave here, I supported this, do you have anything that really pulls at your heartstrings? And sometimes it just takes an event, sometimes it takes oh my gosh, I didn't know that the this XYZ organization had this much of an impact until today, and now I do. And then that's you just got to be ready to, hey, maybe it's something we should talk about, starting to set up a way to get a tax win and benefit the organization at the same time.
That's great, Kurt. And this is a really good segue to the next piece of our conversation. And while I invite my colleagues to join us in the room here, I wanted to say too that that's a great example, Kurt, of charitable gifting being taught to the next generation. And it's a particularly impactful spot for your community foundation to be your partner, because we work with multi-age families. We work with donors of all different sizes and ages and all over the country. In fact, they don't need to be located here in central Minnesota for us to be able to assist them. So don't be hesitant to call us and tag us in on that, because those kinds of conversations really matter. We often find that when a donor comes in and says, I've been told to ask about a donor advised fund, that when I start peeling the onion a little bit, I send them back to one of you to say, which assets make the most sense? Because you could do this, or you could do this, and something comes up in conversation that triggers my thinking, and we'll need your expertise on providing that assistance to those donors. So we just really invite you to invite us into the conversation right away so that we can be your allies and help. And sometimes the fund needs to go somewhere else, but most of the time we find that we're a really good fit when the advisor trusts us enough to help transfer that relationship. So at this point, I'd like to invite my colleagues, Greta Stark-Crocker with the Central Minnesota Community Foundation and Holly Witt with the Alexandria Area Community Foundation, to share just a little bit about how you can work with your local community foundation. And we're going to start with Greta.
Sure. Thanks to everyone who's on the webinar today. It's great to see everybody and have such a good turnout. We're grateful at the foundations to have our professional advisors and appreciate our partnerships with you all. There's about 5 things that come to mind when Holly and I were talking about things that we want our advisors to know at year end. And the first one I would say is really, we are here to help you. We are here to help you work with your clients. And we understand that the relationship is first with your clients, who then becomes a donor. We believe in concierge level service and take the time to listen to our fund holders' interests and serve as a vehicle for them to achieve their philanthropic goals. We also provide investment expertise. That was a tongue twister. We have an investment committee that meets regularly to review our investment portfolio, and we offer investment options to our fund holders. Donors can recommend the pool they would like to have their fund invested in. And just a quick reminder that at year end, gifts of stock, if you can let us know ahead of time, like Sarah mentioned, by Christmas would be great. And with that, I would turn it over to Holly to add in the additional things to remember at year end.
Thanks, Greta. With everything that Greta said and what Sarah have already said, I don't really have much more to add. This whole idea, it's really fun to hear Joel and Kurt talk about the relationship with the community foundations. And, we're all trying to do that in our communities. We're really trying to connect with our advisors, with attorneys, with accountants, and so that we have that trusted relationship. One thing I would say, if there's donors on the call, we work often through our advisors, the professional advisors. Donors can contact us directly as well. We do like to work with advisors and work as a team to make sure that, everything is done the way donors need it to be done for them specifically. So, but I would just say, if you're philanthropic or if you have a client, again, who's charitably inclined, just think of us. Just think of us. We appreciate that. And again, we're here to help. And that local aspect too, I'm working with a couple who moved to town, new to town. They want to open a donor advised fund, and they do have one charity that they'd like to give to, but beyond that, they don't really know the community. And so they've asked if I would be willing to just meet with them and just give them some ideas, because we're local and we have a pulse on the community. We're in the community and active and involved. We know the nonprofit sector. And so, that's a service that we can provide too. When Greta mentions we provide concierge level service, because we are local, we can help donors and just make recommendations and let them know what's happening in the community. So that's a service that we provide too. So on the timing issue, I met with a potential donor yesterday and, sold a business and he's really ready to go. I said, hey, if you're ready to go, do it now. Please don't wait till December 22nd. I mean, we can do it. We can turn these things around quickly, but it's, we get a lot of those at the end of the year. So I just make a recommendation that if you've got people who are ready to go and want to start DAPs, we can do it now too. So I think with that, I don't have anything more to add, and I'm going to turn it over to Kai.
Thanks, Holly and Greta, for those great tips. My name is Kai Tran. I'm the Executive Director for the Community Foundation of Carver County. As we wrap things up for today, I'd like to first thank our speakers, Kurt and Joel. It's always a pleasure to work with people who are willing to share their knowledge and able to explain it at a level that even I can understand. And thank you for all of you for attending. We know that time is our most precious asset. So thank you for spending it with us today. And we encourage you to keep the conversation going, keep learning. Reach out to your local community foundation executive director. We've got Sarah Carson in Willmar, Greta in St. Cloud, Holly is in Alexandria, Carl is in Brainerd, and I am in Carver County. You can also reach us through a website. There's a lot of planning guides and calculators there to get you educated as well. And as always, please let us know how we're doing. We welcome your feedback and comments and on how we can bring more value to our time together. So stay tuned for future webinars, and thanks again for your time, and have a great rest of your day. Thank you.